Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planner, CFP Tim Stearns, founder of TJ Stearns Inc. And what we always appreciate the time and guidance on the program, Tim. Today, talking everybody's favorite topic, taxes.
Yes, everyone loves to talk about taxes this time of the year. And you know what you said the other day was, this is tax season, but really tax season's 12 months out of the year.
We should be thinking about taxes, planning for taxes, being strategic with our tax approach on an ongoing basis, Tim, because it's no one's moral, legal, or ethical responsibility to overpay in taxes.
I would agree with that. What we're seeing though is most people are reactionary. They get their bills after, about now they get their 1099s and all that fun stuff. And then they start realizing what they really owe the government. When we're doing income allocation plans for people, we factor taxes in there. A lot of people don't do that. And they say, oh, well, I'm going to be in a lower tax bracket. But I have found that most people are about where they were. They might be saving in one area, but spending more in another area. The thing I hear a lot about is, every day is Saturday to them because they're retired, so they're spending more in, like I say, in some areas and spending less in others. At the end of the day, the Cook County board doesn't say, oh, well, you know what, your taxes are going to be in half now that you're retired. Your utility companies, the bills still come, and I always ask people in our classes, in our retirement rescue classes, where is your check going to come? If you quit on February 1st, where's your check come the next month in March? What's that going to look like?
Well, if you would like to take a look at your finance, your investment, your retirement plans with a proactive tax perspective, then give TJ Stearns Inc. and CFP certified financial planner Tim Stearns a call, and you can go over that Protect and Grow and written retirement income plan. And you can take a look at the tax strategies that are available that can help you morally, legally, and ethically mitigate, and in some cases, eliminate unnecessary taxes, keeping more of your hard-earned money. 800-640-2256 is the number to call. That's 800-640-2256. 800-640-2256. Tim, nowhere is it written in stone, nor in the tax code, that retirees pay less in taxes, but that is what we are taught. That's the entire pretense under really what is the American system for saving for retirement.
Well, when we talk to people about the retirement, we ask them, what do you think your biggest cost is going to be? And off the bat, they'll say, well, I think it's going to be medical, health insurance, that type of thing. But I say to them, the number one thing is going to be your taxes. Then comes medical, and that can be a lot too. And so we also make sure that the people are understanding that gross versus a net number means a heck of a difference. A lot of these people that are listening to our show are baby boomers, or younger, like my age, 50, and most of us don't have pensions. So whatever, we're creating this time bomb, right, that is going to blow up on us when we're retirement because we're deferring all these taxes. We're maxing out, we're getting all the profit sharing, and I'm all for that free money. But after the fact, you're building up a issue that's going to be a big tax burden. And then you add on the Secure Act, and that's going to be a tax burden to your family as well.
Well, we want to keep as much of our money as possible, and some of these changes in law, changes in tax code, changes in tax rates are going to be of impact, and we need to plan strategically and proactively as we are saving and investing. Tim, it's not on the doorstep of retirement that we really want to give this kind of second thought and examine our methods for saving for retirement. We need to do this on an ongoing basis, as we've talked about, and not make a gross planning mistake, kind of an intended play on words and pun there. Gross planning mistake, meaning that we look at the lump sum we've saved and accumulated and sort of forget that a tax bill is due right within that number that we see.
Exactly. So, I mean, let's go back to when we're all working. All right. The hierarchy is like this. Number one, we pay our taxes. Number two, we pay our bills. Number three, we spend it. And then the fourth thing is we're saving, hopefully, right? When you're retired, it's a little bit different. So first of all, you pay your bills with your retirement money. Secondly, you spend it, right? And then the third thing is you're paying taxes on that money. So I implore a lot of our clients, if they're younger and they're going to still work for a while, to try the 401k Roth, that type of thing that can maybe kick the can down the road. A lot of people are kicking the can down the road with 401ks, the original ones are IRAs with tax deferred money. Why not try the 401k Roth if your company offers it? Because, now they have the Medicare surcharge that's hurting people. It's all based on your means testing of your income. These are things we try to explain to people that, or doing Roth conversions can also help too. Right now is a great time to be doing that.
Tim, because of that change in operations, I think you're right. As we are working, oftentimes the bite for taxes gets taken out before we even see our money. And because it's unnoticed, because we don't have to write a large check for it, we largely don't have a pain point around that, or at least maybe not as much comparatively. And I guess that's my question. Do you find that because the order of operations shifts, because retirees by and large are now in charge of making sure they pay their own tax bill, that is a higher pain point once we reach retirement than it was while we were working?
I am really surprised by the amount of people that will say, hey, I want to take X out of my IRAs that they have with us. And I'll say, well, what would you like to withhold? Well, what do you mean? Well, you got to pay taxes on that money. The IRS has never gotten their, piece of flesh, as they say. So these are things that we need to make sure that people are understanding. When you take out that money, all that growth and all that money that you've put in has never been taxed by the government. Yeah. And so it is all taxable.
Well, and people are understandably, I think, Tim, pretty concerned right now for what if we see major market losses, and right. People kind of get nervous when they see a 5% or a 10% correction in the market. They definitely don't want to lose 15 or 20%, but unfortunately in those 401k balances, we've already got a 20 or so % loss. Yep. Because we've got to take that off the top to pay the IRS.
Right. And that needs to be factored in when you're doing an income allocation plan. You have to factor in the biggest bill you're going to be having, which is your retirement taxes. A lot of people in most cases have been putting in money since 1978 when the 401k started. So with that, you have people who have got a huge asset, bigger probably than sometimes their house, and it has never been taxed, which is absolutely a scary road to go down.
You mentioned, Tim, the 401k Roth, and a lot of people are under the perception that if they choose to put money into the 401k Roth, that their company won't match those dollars.
No, that's totally incorrect. Whatever the match is will stay the same. And we tell people that all the time. The other thing we do a lot with our clients is at 59.5, there's that loophole in most companies that you're able to take an in-service distribution and move the money into something that you can direct, or you can have an advisor help with. That too, the profit sharing, any matching that they're doing stays the same as well. Nothing changes, but your risk goes down.
Well, again, if you have questions, concerns, if you would like to plan strategically and proactively for your financial, your investment, your retirement future, and if you would like within those plans to have a proactive tax planning approach, pick up the phone and give CFP certified financial planner Tim Stearns a call, 800-640-2256. That's 800-640-2256. Tim can help you design that protect and grow plan, including the written retirement income plan, which often helps to mitigate a substantial amount of taxes. Tim, this is not something that we do on the doorstep of retirement either, or not explicitly and
No, you
exclusively
should
on
get,
the doorstep of retirement, because when we're working by having that written retirement income plan, it might help us to identify strategies where we can save on taxes in retirement.
I always think it's a great exercise to go through an income allocation plan to see what your bills are going to be like down the road. And then you put in there the silent thief, we call it, inflation. It's at, from the beginning of the year, it's been at 7%. I mean, historically 3.15. I heard an advisor the other day. I went with one of our clients to meet a gentleman that is an advisor, and he said he thinks inflation will be around 2.5% this year. I don't know where he's getting his numbers from, but there's no way, with all the money that we've printed in the last year and a half to prop up this economy and during COVID, it's going to come home to roost at some point.
Tim, you mentioned tax planning. What's the difference? Because we are in the midst of what is traditionally called tax season right now, when a lot of filing is going on. What's the main difference between tax planning and tax filing?
Well, tax planning is getting ahead of it and not being reactionary. Tax filing is, when you take your medicine and figure out what you really owe. I would hate to do that after the fact. So with us having a CPA on staff, it helps extraordinarily that they can understand exactly quantitatively what that amount's going to look like. And that's huge, I think, to know kind of what you're getting yourself into. And the other thing, and we've realized, this only started a couple of years back, that Medicare surtax goes back 2 years. So someone who retired in this year in 2022, they're going to be looking at what they made in 2021 and 2020 as well to see what they're going to have to pay for Medicare. A lot of people don't realize that. We had a client who sold his company and he was in a huge tax bracket. And guess what? He got really dinged up by the Medicare surcharge.
And we will talk a little bit more about the double and the triple whammies that tax deferral can have and the implications in your retirement. But Tim, going back to having that written retirement income plan, when it comes to IRA or 401k or retirement account distributions, or eventually to required minimum distributions, those RMDs, again, having that written retirement income plan, sitting down and crunching the numbers can oftentimes help to pinpoint strategies that will be more optimal, that will cost us less in tax over our lifetime.
Right. Exactly. And you need to make sure that people understand exactly what the tax bill looks like, because rain or shine, that's coming. So I think we should talk about those three whammies that you're talking about.
Yeah, absolutely. Again, if you'd like that retirement income plan mapped out, if you'd like to look at the different scenarios that you have to control your tax future, pick up the phone, give CFP Certified Financial Planner Tim Stearns a call, 800-640-2256. That's 800-640-2256. So Tim, we take the distribution from our IRA or 401k. We need $100,000. So we take $100,000, but not quite, because we don't actually get $100,000.
Right.
We have to pay tax on that. That's the first whammy. But then it actually creates some additional whammies. Talk about the double and triple whammy effect of tax deferral in retirement.
Well, I mean, again, they're doing with Medicare nowadays, they have IRMA, right? And so IRMA takes into effect exactly what you've made the last 2 years previous to what this current year is, right? So they're going to look at your means testing, meaning how much money did you make in those years? And then if you're underneath the threshold, then you won't have that penalty. If you are above the threshold, you'll have that. The other thing people cannot get over is the fact that their Social Security can be taxed yet again. And that's definitely a triple whammy right there, those three things. You got taxes, you got IRMA from Medicare, and then you also have your Social Security, which you in your mind have already paid a tax on, right, to get it
right
in there. Now it's coming out to you and you're getting taxed again. I mean, that's a good morning right there.
Well, it's funny because during our working career, Social Security certainly felt like a tax. The government doesn't actually identify it as one. They are basically withholding it to pay it out to you later, and in which case it could be taxable at that point in time. A lot of people don't necessarily realize that, Tim, but a living wage across Chicagoland area, more than likely, we are going to be paying taxes on our Social Security. And in fact, many of us will hit some thresholds where our Medicare premiums are means tested.
Yeah, and unfortunately, you're exactly right. So you got to make sure that you understand that that's why the time is now for people who are younger to learn from our elders, right? That maybe I should have put some money in a 401k Roth, stuff that won't come to my income. And then not only that, but obviously, in our classes, it's unbelievable how many people don't know about the Secure Act. They look at you like a deer in headlights when you try to explain it to them that, and if you pass and your wife passes within the next 10 years, all of your money needs to be out of these IRAs that you've worked your tail off your whole life to defer money into for your retirement, and now your kids, and they're probably, and most likely their heyday of making money, are now going to have to take your money out. And that's even more income that they're going to have to be paying taxes on.
It's not an inheritance tax. Let's clear that up, Tim.
Of course not, no.
But before you get to inheritance tax, there's still income tax that's owed on your retirement accounts.
Mm-hmm.
So even if those inheritance tax levels, the estate tax levels, remain remarkably high, and that's a big if they remained there, for most Americans, Tim, before they ever encounter that, they're actually going to have to pay a first round of tax on those tax deferred retirement accounts. That's income tax. And those next generation beneficiaries, it's a default windfall for the IRS, Tim, because now those beneficiaries are required to liquidate the accounts within 10 years. I guess they figured that if they're receiving a large amount of money, they're not going to complain. And the people who saved the money and then passed it on obviously aren't there to complain. So that's the perfect time to kind of hit those retirement accounts.
Right. And unfortunately, when I went to DePaul to learn how to be a certified financial planner, we had a teacher and he had his master's in taxation. And we were saying to him, boy, that's really nice that underneath George Bush, we all received these checks, from GW's era, his presidency, where we got money. And he said, his comment was, and it resonates today, is that they gave you something in your left pocket. I promise you, they took something out of your right pocket. And we see that all the time now. Now they're saying, well, you know what? Your required minimum distribution's not till 72. Oh, well, that's nice. I get a year and a half from 70 and a half. That's good.
And they took away generations of available tax deferral that we had before.
Right. The stretch IRA that everyone was utilizing is gone. And so you have to drain your parents' accounts within 10 years of them passing.
Here's where, Tim, I think people have come to realize they are in a business arrangement, a business partnership with the IRS, and the IRS and the federal government get to set all the rules. We don't have much control in that business partnership arrangement.
Oh, I don't disagree with that. Interesting article I read the other day that an average IRS agent takes over 16,000 calls a year. Can you imagine the type of service that we'll get from that? Because they're so strapped. They're also telling people to make sure that you do electronic filing and give them a bank routing number so that you don't get a check in the mail, because God knows when that check's going to come. It goes on and on. So, there's a lot going on there. And our CPA advises all of us to send stuff registered mail, make sure that you are covering your bases, because no one's got your back but yourself.
Again, we are talking with certified financial planner Tim Stearns, and he does offer to help savers and investors across the Chicagoland area to get that plan put together, your Protect and Grow financial and retirement plan. If you'd like to get that plan or double check your current financial, investment, and retirement outlook, pick up the phone and give a call. 800-640-2256. That's 800-640-2256. Tim can take it at any level you like, a very high level review, or get into the minutia and all of the details with the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, and write down, structure, and get a written retirement income plan. Where and how to create income in retirement, what assets, what accounts to tap, in what order to create an optimal outcome for both the income and the tax situation. Again, the number 800-640-2256. That's 800-640-2256. And Tim, throughout the course of this program, you've offered a great resource. Now, some savers and investors across Chicagoland have read income allocation, but
Yep.
many, many more have not. This book is really an essential retirement planning strategy guidebook that more people need to read and understand.
If you're getting ready to retire, or even if you just did, the income allocation book will really put into concrete what you need to do and how to get yourself ready for, hopefully a successful retirement. You're seeing people that are just going into this winging it. One of the analogies we use in our class all the time is, if I'm a contractor, I say, I'm going to build you a house and I don't want to provide you what the cost is, and I don't want to provide you any blueprints. Do you sign up with me? And everyone laughs. Oh my gosh, I would never sign up with someone like that. Yet in retirement, a lot of people are, well, I think I'll be okay. I hope I'll be okay. And what happens if you run out of money at age 80 and then you realize you weren't okay? A couple bad years in the market can really, really do damage to a portfolio that people thought 13-year bull market, it'll never end, and the Fed has said they're going to start tapering back what they've been doing to prop this market up. We need to get real about what's brass tacks.
And one of the biggest indications, Tim, that we are heading into retirement without a blueprint is if we don't understand our tax plan and have mapped out how we will address the tax liability and the strategies that we're going to implement to minimize and control that tax liability.
You need, not having a plan is having a plan, unfortunately. And the last thing you want to do is be taking out money where your Social Security is getting taxed, your Medicare, you're paying more for it than you really want to. And then lastly, you're getting taxed on all your different 401k distributions into your pocket. So, speaking of a triple whammy, there you have it, so you need to make sure that you're getting ahead of it, because being reactionary in this day of age is not the proper way to do things.
Well, again, if you would like help and assistance, if you'd like to structure that plan, pick up the phone, give a call, 800-640-2256. That's 800-640-2256. And Tim, it's more than just a fear. It's more than just a thought. It's more than a belief. It is, in fact, already in the tax code. If nothing further is done, we will be paying higher taxes in the very near future.
Absolutely. And people don't realize that taxes are the lowest that they've been in forever. I'm always surprised that no matter where I do a class, whether it's Arizona or Florida or other offices or Chicagoland, I say, what do you guys think taxes are going to do? And everyone gives me the thumbs up. That's going up. No one has ever said, oh, it's going to go down. That's one thing as Americans we can agree upon. They're going to tax us more and more because they have to pay for all these programs that we're doing, and the federal deficit that just is growing leaps and bounds every day.
Again, if you'd like to identify some strategies so that you can better control your tax outcome, that's part of the Protect and Grow planning process there at TJ Stearns Inc. with certified financial planner Tim Stearns. 800-640-2256. That's 800-640-2256. Tim, what are some of the strategic opportunities that you are helping savers and investors identify now to take advantage of and control that tax bill in the future?
Well, right now is a Roth conversion time. If you're late 50s to early 60s, it's a great time to do it. Again, taxes are so low right now. How do you get, I'm not telling people to take, $1 million and make it a Roth conversion, because they'll put you in a tax bracket you want no part of. But that being said, taxes are going to go up. So why not do some of it to the different thresholds that you can get to as a joint married couple or as a single individual that's filing? We help people with that all the time. It's a great opportunity.
There are many people, Tim, who could potentially be in one bracket that in just a few short years will be in a significantly higher bracket. In fact, between the 22% and the 24% bracket, there's a lot of opportunity there, because the 22 is actually slated to move up to the 25% bracket in just a few short years. And so there's a whole nother bracket there, a lot of wiggle room to do some proactive planning.
Right. And you figure that the average male will live to be 85 and the average female, according to Social Security agency, will live to be 88. Doing it in your 60s to kind of nibble on your tax bill, that's a great idea.
Well, taxes are a pain. Nobody ever wants to face them. Nobody wants to pay more than their absolute legal minimum. But Tim, the way that we have been taught to set ourselves up for retirement in fact, oftentimes leaves us paying the highest possible tax bill in retirement.
Exactly. And that's scary stuff, but it's true, because, the kids are out of the house, those exemptions are gone, that type of thing. Now it's just you and your wife, you and your husband, what have you. And you're looking at, a tax bill that doesn't go down. It usually goes up.
If you would like to look at solutions for your financial concerns, if you're worried about the risk of the market and losing money, if you're worrying about the taxes that you may be liable for, how to address and handle those and minimize those where possible, how to keep more of your money working hard to support you during your retirement so that you can enjoy more of it, pick up the phone, give a call to TJ Stearns Inc. and Certified Financial Planner Tim Stearns. Request the Protect and Grow plan. For the first 10 callers to today's program with at least $500,000 saved for retirement, you can also receive a copy of that essential retirement planning strategy guidebook, Income Allocation. It is being used across the country by advisors, by savers and investors to identify the risks to today's retirement paradigm, the way we've been taught, and provide solutions for how to solve for many of those issues and address the risks that we are facing. So give a call right now, request the Protect and Grow plan as well as Income Allocation, 800-640-2256. That's 800-640-2256, 800-640-2256. And Tim, since it is tax season, I'm sure we'll be talking a lot more about taxes in the weeks to come.
I promise that.
Well, we always appreciate the time and the guidance that Tim Stearns, Certified Financial Planner, CFP Tim Stearns, provides us here on the program for the savers and investors, those serious about their financial future across Chicagoland. Give a call if you've got questions or concerns, if you'd like to put that Protect and Grow plan together. 800-640-2256. That's 800-640-2256. Or call and request your copy of Income Allocation.
Tune into Chicagoland Certified Financial Planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.